Welcome back to our two-part podcast series, Cutting Out the Middleman, the surge in FinTech applications to charter banks, industrial banks, and national trust companies. I'm Alan Kaplinsky, the founder and former chair for 25 years and now senior counsel of the Consumer Financial Services Group at Ballard Spahr. And I'm very pleased to be your host today on our repurposing of the webinar. And today we'll be focused on part 2. If you're just joining us, I encourage you, before listening to part 2 of this podcast, you really should listen to part 1, where we set the stage by exploring why so many fintechs, lenders, and payments companies are seeking to become regulated entities. And we compare the different charter options available to them. And we focus on the use case for crypto native companies. In this second episode, we pick up with our expert panel to go deeper into the application process, capital requirements, regulatory expectations, and the practical realities of moving from application to launch. And we'll also be focused on 2 additional use cases. First, for lenders, and in particular, companies engaged in the buy now, pay later business or the earned wage access business. And the reason why those lenders, non-bank lenders, are very interested in converting to national banks. And that is, of course, in order to cut out the middleman and create greater certainty with respect to their authority to export interest rates allowed by the laws of the state where their bank is located, and ignore the usury laws in the borrower state. And all of that comes from the U.S. Supreme Court opinion in Marquette National Bank versus First of Omaha Service Corporation. And we'll also be discussing the use case for non-bank payments companies. So our discussion today will continue with Scott Coleman, partner at Ballard Spahr and experienced bank regulatory counsel, Lee Reiners, lecturing fellow at Duke Financial Economics Center, Bo Hertig, a former associate general counsel involved in organizing a national trust bank. Bo is now he's of counsel at Ballard Spahr. Adam Merrick, who advises a range of payments and non-banks clients, also at Ballard Spahr. And Joseph Schuster, noted for his expertise in payments, lending, crypto, and artificial intelligence. He is a partner at Ballard Spahr. So in the episode today, our panel will be examining the critical importance of submitting a well-developed business plan and preparing for regulator feedback, the phased capital raising process, and the major milestones you need to hit before opening for business, the realities of the regulatory approval timeline, and what I call the culture shock for non-banks and other fintechs as they transition to regulated entities, namely national banks or national trust companies. How regulators approach risk. We'll talk about business plans that are required by the comptroller, and the ongoing oversight of new depository institutions. And finally, we'll provide a lot of practical advice for assembling the right team and navigating a process that remains complex, resource intensive, and highly strategic. And as I mentioned at the outset, we'll be very focused very early on today in the use case for lenders, buy now, pay later entities, and earned wage access companies. Thank you for joining us for the second half of our program. Now let's continue with part 2 of Cutting Out the Middleman. I'm going to turn now to Joseph. And sorry, Joseph, I ended up putting you as the last speaker. Hope you don't mind. But I know you've got a lot to cover, but we're going to have to cover it in a short period of time. And my first question for you is, why are lending platforms increasingly interested in obtaining charters?
Yeah, it's a great question. And I will say that, I should say on our slide, we say lenders, and we have parenthetical BNPL, earned wage access. We do not think that earned wage access is a credit product or paying for BNPL providers. We just wanted to make sure that we talked about that as well. I'd get some emails about that otherwise. I would say that, and a lot of people have kind of talked about a variation of this question. And one word I think comes up a lot, and that's control. There's, I'd say, two kind of pieces within that control. There's a business reason and there's a legal reason to this. There's a question, I think, by the fintechs or the partners of banks generally. I won't just say fintechs because, like I mentioned earlier, you have retailers, you have airlines, you have technology companies, all kinds of different entities that offer a co-brand credit card, or you have the traditional fintech that are partnering with banks to offer credit to really the customers of that other company, that retailer, that airline, whatever it is. They're great customers. The fintech's customers are wonderful customers. They want to be able to control how they extend credit to those individuals. They want to be able to offer credit to as many of those individuals as possible. I think that we have seen some alternative products kind of emerge as a result of regulatory requirements pushing more traditional financial institutions and some partner banks into reducing the credit that they're willing to offer to the customers of the fintechs, to the customers of others. If entities want to say, hey, this is my customer, they're a great customer, and I want credit to be offered to that customer, like having a bank is the best way to do that. From a legal perspective, all of a sudden, they become the true lender. When it's a fintech bank partnership, that bank is the true lender, regardless of what states try to say in those instances. That bank is really the true lender. In these instances, they can control the product, the underwriting, the service, the customer relationship. That customer relationship is so important, I think. That's where, as Lee was talking about granting more national banks, there is, and I think there's kind of differences amongst how those banks are operating. But from a consumer perspective, I think that there's a massive benefit from this. That we have seen regulators, at least in the last CFPB administration, really try to make credit more difficult for consumers to get. I think that competition within banking would be beneficial and would offer more credit and more affordable, good credit products to more people. And that goes back to that. I have my customer as a fintech, and I want to be able to do for my customer the right thing.
So interest rate exploitation is central. Am I right, Joseph? I mean, and I know you've talked to a lot of fintechs about, having a charter and a national bank charter in particular. That's the first thing on their mind, right? But the second thing is a funding advantage. If you've got deposit insurance, presumably your cost of funding the loans that you're making is going to be less than what your funding is as a fintech.
Yeah, it's a great point. I'd say that it's in the top 3 of reasons for the decision for sure. I do think that number 1 is control. You have a lot of companies that maybe they would be able to offer their product, or they are able to offer their product within the interest rate limitations from a state perspective, but they might be partnering with a financial institution, again, because of the funding, like you're mentioning, Alan. In those instances, and this might be in the higher dollar type of credit piece, think of a securities-backed line of credit or crypto-backed line of credit type of credit products. For those, you are subject to the whims of the financial institution, of that banking partner of yours. Even though this is a great customer, that they should be offered that credit, that's not necessarily the decision of that partner in those instances. So I do think that control is number 1. That exportation, though, I'd put that in the top 3, probably at number 2, because you do see, and that's what I was talking about a little bit, that there has been, I think, of the banks that are operating in this space right now, and certainly, some of the bigger banks, that they've been pushed by regulators to pull back in terms of the credit that they're extending to more vulnerable or credit risky individuals. That is not the best thing for consumers. There is opportunity there. People who have experienced the pullback of that credit are looking at alternative sources for that credit. They are working with fintechs. Fintechs are working on partnering with banks in order to be able to extend credit to those individuals. There is an interest rate exportation in some of those instances where that is very important. So I do think that is an important aspect of this in order for the fintechs who are looking at the opportunities that are available as a result of that pullback in some of the credit offerings, that they need that exportation. The funding one is also extremely important, that there could have been reliance on warehouse lines of credit or different sources, forward flow arrangements, whatever the case is, that now you have access to deposits as a funding source. Deposits are generally the cheapest funding sources available. It is why you see some large institutions that have banking charters that don't do any credit functions out of them, that the access to deposits, that funding source, is very valuable as well. I'd also say, though, that it does go back to that, in that consumer space, that customer relationship. If you're able to offer the credit products, offer the deposit products, payment cards, other financial services, that you're really able to provide a strategic benefit. You're able to help individuals that maybe some other banks have stepped away from as a result of regulatory pressure in those instances. So I think that the exportation, control, funding, all extremely important. And I think that there's the fintechs are kind of recognizing the massive benefit that they can have by having these banks and control those customer relationships that are their relationships really, but they're not the true lender, and they're not able. They lack some control by outsourcing them.
Yeah. So, Joseph, how does the compliance burden change post-charter for these fintech companies that are interested in getting a bank charter? It can be quite startling, right? Some of them are hardly regulated at all, or they're regulated through state banking departments, and being regulated at the federal level is a bigger deal, right?
Yeah, I'd say that the compliance burden, and originally, when you had put together this question, I wrote down that it changes dramatically. But then as I was kind of developing the answer, I'd say that it changes somewhere between dramatically and minimally. Because you are right that some of the fintechs are not really regulated in this space, or some of the partners are not regulated. But there are some that are taking on a lot of that regulatory burden right now as they partner with banks, of saying, here is a proposed compliance management system that you bank might want to consider for this program, and we can help you kind of implement it. So you will have some of those things. They will have built Truth in Lending Act policies, your FCRA, your Electronic Funds Transfer Act policies. They'll have a lot of those things. So in certain instances, there are fintechs that because of their partnership with banks are a lot further along on this structure than others. I think that when you get a bank charter, there does need to be that formal risk management structure in place. As Lee was talking about a number of the crypto firms that are obtaining bank charters, I think that they have had compliance considerations to some extent, but maybe the formality of the requirements that a banking charter requires will be a bit of an uplift there for them. So it really depends, I think, on who the entity is, but I don't think that is a reason to, if there's a consideration for obtaining a bank charter, to shy away from it. That's something that is, I would argue, a well-worn path, and something that we advise on all the time.
Yeah, and particularly if you already have a lot of state bank licenses and that you have to renew every year, and they all have different requirements, you can get rid of all of them. You don't need that. Lending is about the most quintessential bank charter of power that exists. The one thing I don't want to get into any detail on it, but it's something that ought to be factored in, is how much you can leverage your capital. And that may be different if you have a bank charter than if you are just a fintech and you've got some kind of warehouse line of credit where there may be restrictions on your leveraging capability, but it may be sometimes more lax and sometimes more rigid or tougher than what the regulators require in the way of capital. So I just wanted to mention that. So I'm going to end your segment with a really tough question, Joseph. And that is, what do you think the bank regulators are going to do? Do you think they're going to approve the change of control applications that have been filed by a few high cost, and by that I mean triple digit APR online lenders to acquire national banks, despite what I would describe as vigorous opposition of many consumer advocacy groups who have been very outspoken? They've written letters to the comptroller of the currency saying this is outrageous that you're going to allow all these companies who are charging these exorbitant interest rates to just run roughshod over consumers.
It's a great question. Yeah, I think that they will. I hope that they will. I think that the current administration recognizes the consumer benefits of competition, that I think we see a lot less kind of paternalistic regulatory framework happening right now. There's the question, sure, does federal law allow a national bank to export interest? Right now it currently does. I think that they will look at important questions like whether the entity is financially sound, what their business plan is, the controls that they have in place, that compliance infrastructure that we've talked about. But I think that you see, I would argue, consumer advocates on both sides of the ones that you talked about. But I think that there are also the consumer advocates like myself who recognize the benefits of being able to provide credit to individuals, and that if credit is not provided by a regulated financial institution, that there might be the need for that credit does not go away. And there are tremendous benefits to people of being able to have access to credit, to be able to access the financial system of the United States. And so I think that is also a consideration that I hope that is being considered as these charters are being evaluated.
Yeah, I might say, just a footnote to that turn back the clock by a few decades ago when payday lending was, very pervasive, and payday lenders that partnered with national banks. The comptroller of the currency didn't like that. They considered the triple-digit APRs to be contrary, that they created an enormous reputation risk. Reputation doesn't exist anymore, right?
Exactly. Yes, it should not be a consideration. Every now and then we hear it, but it's not something that's supposed to be considered right now to the benefit of people who are operating legitimate businesses and to consumers.
Yeah. Okay, well, thanks, Joseph. And Adam, this is going to be very quick because we got a couple of other segments that we have to cover. Just for our listeners' benefit, we'll probably run about 10 minutes over. So instead of ending at 2:30 Eastern time, I apologize in advance. It'll be closer to 2:40. And
I think I do want to add on that, though, Al, just on the delay. People will still receive their CLE credit if they drop at the bottom of the hour. So
absolutely. Yeah, and you will be receiving the full audio in a few days, along with all the written materials and outlines that we put together. So, Adam, you spoke earlier about the infrastructure issues and the advantages of having access to the payment systems and a master account. You may have already answered this question, but I think it bears re-asking again, and that is what's driving these payment companies to seek either bank or trust company charters. They're not involved in lending money, most of them anyway.
Yeah, I'll be quick here, and I touched on some of this already, but it's really the convergence of economics. Can the company capture interchange, deposit float? Maybe federal preemption is relevant. Payments company, do they want to reduce the sponsor ban, their revenue share? So you got economic levers there. The infrastructure, do they want to be able to directly interact with it from a technological perspective? They want to own those omnibus and FBO structures and have better control of settlement, and in that process, improve the product. And then manage concentration risk. So if you're dealing with multiple or a single sponsor bank that's really even one or two sponsor banks, do you still have concentration of risk? And so by owning that risk and getting a charter, you can internalize all those things. But I will say that comes with some risk in its own right, that all the things that a payments company is going to depend on a sponsor bank to manage are then going to become burdens of what will become a bank itself. So think BSA, AML, vendor oversight, IT exams, capital planning. We touched on a lot of the complexity of becoming a bank. And so that then all becomes internalized by the fintech.
Yeah. Okay, I'm going to move to back to Scott. And Scott, you started us off, and we're now going to talk very briefly, or I'm going to ask you questions about how do you go about getting a charter, right? So number one is, do you organize the bank from scratch, or do you go out and look for a bank to acquire and use a change of bank control application?
Right. Both are valid options. I think one of the first questions I ask someone who's considering that is, why do you want to buy the bank you're proposing to purchase? Because you're going to have to explain to the regulator, are there synergies to it? Did you just because it's a low capital cost pick the smallest bank you could get that's a national bank charter? And if so, you're going to have some questions about your commitment to your own business plan. At the same time, the charter process is often longer. It can take a year plus in many cases. And if you're able to acquire an existing bank quicker, that's a positive. It's also the case that if you acquire an existing bank, presumably, ideally a profitable bank, you'll probably have less burn as you're growing because you'll have that base to absorb from, including a base of deposits and existing loans. So there are advantages. The disadvantages can be a distraction from your core business model. It might be located in a geography you don't care to be in. If it's a rural bank, do you have management succession issues you have to worry about? Does it become a distraction? You've got to balance all of those things when you're deciding which route to go.
Yeah. And how should firms think? I alluded a little bit earlier to capital requirements and the ability to leverage, and the restrictions that are there in the banking regulations. But you have to think very much about those capital requirements, and you've got to make sure that you don't just comply with them, that you've got a nice cushion. The regulators don't like it if you just meet the capital requirements. You got to have that detailed business plan too. It's got to, and the business plan's got to make sense, right? Yeah, why don't you tell us a little bit about that and the need to hire a banker with experience? It may not be adequate to just use your existing non-bank fintech management.
I like to dumb this down and say any application for regulatory approval of a transaction like this is telling a story. And in telling that story, you've got to address three things. One is your business plan. Your business plan has to be compelling. It has to be based on assumptions that the regulators find reasonable, and you have to support those assumptions. And that includes not only what you're going to do if you're going to be lending, how much you're going to be lending, to whom, is there demand for it, how are you going to fund that, what core deposits can you generate, what non-core deposits will you have. So the business plan is essential. Character and fitness of management is going to be key. You're going to have to demonstrate that you have existing management or management that you will hire day one who has the ability to effectuate the business plan. I had a conversation with someone the other day where they were proposing to acquire a smaller national bank to operate a national mortgage lending platform. And they wanted to keep the existing president, who has no experience operating a national mortgage lending platform. And I said, I think that's going to be a challenge from an application perspective. The OCC in particular wants a management team that has served in that role before at a national bank and has the experience to do that. The last piece is capital. And you're right, it can't just be meeting the regulatory minimums. There are a number of factors you have to consider. We don't have time to go into them all, but you'll want to look at, okay, what if there are downturns? What if you don't meet your expectations? What if there is credit risk? What if the environment changes? What extra capital are you bringing to the table? And then the one thing with capital that many organizers forget is that you can't grow into it. So when you're putting together an application for a de novo, a new bank charter and deposit insurance, if you're proposing to be $1 billion bank at the end of 3 years, you need to have enough capital day one that you're well capitalized when you hit that billion asset mark. You can't grow into it. A lot of organizers like to think, well, we'll do a follow-on capital raise. We'll go down the road a little ways. We'll raise more at a higher multiple. The FDIC policy is you must have that capital committed day one. They're not going to assume the risk that you are successful in a follow-on capital raise. You may be so successful that you're going to go in and propose to change your business plan and ask 2 years out for approval of a change in business plan and bring more capital in. That's fine, but your base projections are going to dictate what capital you have to bring to the table day one.
Right. What are the key steps in the application process? You mentioned earlier you can have a pre-application meeting, and I would encourage everyone to do that before they, start putting together the application. But what about the rest of that process?
So pre-filing meetings are useful. Pre-filing meetings should be accompanied by experts who are used to the regulatory language you're going to hear when you're having that pre-filing meeting. I like to get at least a 50 to 75% complete business plan established and provide that to the regulator before the pre-filing meeting, because we're going to get a lot more knowledgeable feedback. But the application process is really about, putting together the business plan, vetting the business plan with the regulators, providing detailed projections, going through the application process, filing the background check, getting your preliminary approval, going out then to get the capital that's been committed, collected before you open on a day one.
Yeah, and you may be doing a public offering, right? I mean, it's a possibility.
That is a possibility. Whether it's public offering or private placement, you will want to have at least 50% of your capital committed before you file the actual application. So you'll have done some capital raising at the time. Probably you're going through the pre-filing process and assembling the application. File the application with 50% subscribed for. You won't get approval until you demonstrate you've got commitments for 75% of the capital you've proposed in your business plan. And even with that approval, you don't get to actually open for business until you hit the 100% mark.
Right. What are the most common pitfalls or things that could cause delays in getting approval?
So, number one, financial projections and a balance sheet model that doesn't fit regulatory expectations. So you'll want to work with accountants who have experience not only in, creating a balance sheet, but in particular have experience doing projections for financial institutions. But one of the biggest issues we see that delays things, especially if you're pursuing a bank holding company application with the Fed, is not really being able to delineate what all the interrelationships of your group of shareholders is, because the Fed wants to determine who is in control and whether people have acted together to be in control. So you've got to manage all of that, or it can really slow down the process.
Right, right. And nobody should think that they can just slap together, a business plan and that's going to be acceptable. This is going to be, and you've got to have experts with you that have been through this process many, many times to counsel you how to do it.
That's right.
Okay,
there are experts that.
Yeah, go ahead.
I was going to say you need the experts to do the projections for you. You need the experts to assemble and vet the business plan. You need the experts to help you raise your capital. You need the experts to put together any shareholder agreement, go through the application process. You need to identify your management. You may need to hire them early. So again, the de novo application process for deposit insurance in a charter is an expensive, burdensome, timely process.
Right. Thank you. So, Bo, you're going to wrap this up for us. But this is really an important topic. Life after the charter. You have your charter now. You're up and running. What surprises firms that have been through the process once they've become a bank?
Yeah, and again, remember, I've lived this experience. I was associate general counsel of a payroll company that started a national trust bank. And so you went from a commercial enterprise into now a regulated entity. And I will say at first, it is a culture shock. And I've tried to think of analogies to explain this. And one of the best ones I can think of is, let's say you have to drive 200 miles, you're going on the freeway. You might want to get there in a hurry, so you'll set your cruise at 75 and a 65. You'll probably get there a little faster. Probably no one will catch you. Well, now the change to having a regulated entity is, there's going to be law enforcement on that highway, and they know, they're going to be watching for you. So you're probably not going to set your cruise control at 75. You might even set it at 63. And so things are just going to take longer. When you're making changes to your business plan that we talked about, oftentimes you'll have to get approval for that, especially if you're in your de novo phase. You may not even be allowed to change your business plan until you've established yourself. The regulators may want to see your board minutes so that they can see what's going on. Again, you're going to have to earn the trust of the regulators. You're going to have to work within that framework, and it's way different than business as usual at an unregulated entity.
Right.
So buckle up.
How intensive is the supervision and examination processes? I've been reading a lot about, and in fact, we've done other podcast shows about how supervision is becoming a little, they're getting away from the check the box kind of supervision where they were unable to check the box in a certain area that they're looking at, they'll write you up. You'll get a matter requiring attention, or you might even end up in the enforcement arena. But now the things have changed somewhat. But I'm wondering whether the changes are really going to apply to the de novos. Do you have a reaction to that, Bo?
So what you read is accurate, and as you explained it, there's really now a focus on actual financial harm, and we understand that, and I agree that's probably the standard that's communicated and with existing institutions. But I will say, we talk about supervision. It does serve a purpose. The examiners are going to look for and enforce BSA AML compliance. They're going to look for and they're going to enforce vendor management, information security. These are important things that should be taken seriously. If you have problems with those items, there's going to be harm. You're going to have certain damage to your institution, and it's sort of not great in general. So we can talk about the pendulum swinging. I think Scott mentioned that. I can also say, remember, we submitted the application in Trump 1, organizational phase in Biden, operational phase in Trump 2. I would say while there's sort of a general tendency for the regulators to be maybe slightly more transparent or cooperative or not, or you could shorthand that easier to deal with or not. They're going to focus on their job. You are going to be regulated. There are no shortcuts. And it is a relatively intensive process in my experience.
Right. So we're going to wrap it up here. And I just have a few closing takeaways that I'd like to share with the audience, and then we will sign off. Let me leave you with these ideas in a very broad way, what we have trying to emphasize today. First, the trend we've discussed reflects a fundamental shift. Fintechs and other non-banks are increasingly seeking to internalize the benefits of being a regulated financial institution rather than relying on these bank fintech partnerships. Second, this has been stated over and over again, there's no one-size-fits-all approach. The choice of charter, whether it's a national bank, an industrial bank, another state chartered bank, or a trust company, is highly strategic and depends upon a firm's specific business model and objectives. Third, while the current environment may be relatively favorable, obtaining a charter remains a complex, time-consuming, resource-intensive process. And you need to assemble a team of experts right from the get-go who've got the expertise and the experience to make it as painless as it could possibly be. And fourth, the use cases that we explored, crypto firms, lenders, or buy now, pay later, earn wage access. Again, I hesitate to call them lenders, lender-like companies, and payments companies demonstrate that this trend is very broad-based, but the motivations and the challenges vary significantly across sectors. And finally, becoming a bank is not just about gaining new powers. It's about accepting a new level of regulatory scrutiny. And let me emphasize, the scrutiny is going to exist well after the Trump 2.0 is done. And we're in a Democratic administration where all the management and the people at the top of the bank regulators is going to change. And they may be people who don't like crypto. They may be people who don't like exportation of interest rates. And I could go on and on and on. And if that happens and they come in to examine you after that's happened, it's not, and you can't say to them, well, we didn't do this or we didn't do that because, you're you used to be more lax than you are now. Look at us going forward. They won't look at it that way. They'll look at what you've done during Trump 2.0, and that's going to be an issue. So for firms that are prepared to make this commitment, the opportunity can really be transformative. Thank you for joining us for part 2 of our live webinar that is now been made into a 2-part podcast series called Cutting Out the Middleman, the Surge in FinTech Applications to Charter Banks, Industrial Banks, and National Trust Companies. I hope today's episode gave you valuable insights into the realities of the charter application process, the regulatory expectations for new banks, and the practical considerations for fintechs making this important transition. If you missed the first part of this discussion, I encourage you to go back and listen to episode 1, which we released last Thursday, where we cover the foundational market dynamics and strategic choices behind this remarkable shift in financial services. And we also talk about the use cases for crypto native firms to become national trust companies. On behalf of our entire panel, Thank you for being with us for both episodes. If you have any feedback or question about today's program, don't hesitate to reach out to us. We appreciate your time and interest, and we hope you'll join us for future webinars and podcasts in our series.